me, I'm super excited to kind of share this information and share the journey that myself, along with my husband, have been on the last several years. I was just mentioning during our happy hour that this journey, while it might look like to some people that this was an overnight success and it was quite abrupt that I all of a sudden decided to leave my corporate career after 18 years with the Walt Disney Company, this was in fact a journey that I've been on since 2017 in building up passive streams of income and really shifting my mindset of what work looks like to me and what I really wanted life to look like. So I look forward to kind of walking you through this journey, sharing information of how I've gone through this process, and then we can talk about potential next steps at the end. First off, disclaimer, I will be talking about real estate. I will be talking about investments that I have both invested in as well as I do offer as part of my investment company. But please know that this webinar, this wealth party, as I've called it, is for educational purposes only. It should not be considered legal, accounting, or investing advice. I will not be making any solicitation or representation of an offer for you to buy or purchase an investment or a security. So know that there is not a sales pitch at the end. And of course, as with anything on your journey, you should consult your own attorney, your financial advisor, and CPA for any legal matters and investments and tax-specific advice. So I want to start at the beginning of stories that we're told as we grow up. We're often told that the path to success in life is to grow up, go to college, get a good job, get married, buy a house, have kids, and then all of a sudden you wake up and you realize, oh crap, I need to pay for my kids' college. And it's a total afterthought that we think about investing for our retirement. And the thought that there's no way you're really going to be able to retire before the age of 65. And amongst this entire journey, we are also paying off student debt. We're buying new cars that we think we need. We're going on vacations because you know what? We want these experiences with our families. But again, investing for retirement ends up taking kind of a backseat to the back burner. And I was on that path, absolutely on that path. And through this journey, I've learned, so there's 5 scary retirement stats that I just want to share with you, kind of level set why I think this is so important that I share my journey with individuals and give people an opportunity to have open and honest conversations about their financial position and about money, and really think, shouldn't say think critically, but really think critically about how they want life to be, not what society has told them, but what they want life to be. One of these is that 26% of non-retired Americans have no retirement savings. That's pretty astonishing in my mind. Additionally, there's lots of conversations about the Social Security system being in trouble. It's going to go bankrupt. It's going to go away. The reality is it won't go away. Payments will get smaller. But nonetheless, even if it stayed the same, the average payments is less than $20,000 a year. That's not much to live on. That's less than $2,000 a month to live on. And 44% of Americans, and only 44% of Americans are investing. So if you are investing in your company 401k and after-tax brokerage accounts, maybe you've done a little cryptocurrency or NFTs, you're at least kind of on that path where you're thinking about investing and prioritizing your future self over your present self. And we all need to live, we need to live in today because you never know when our last day is, but we also need to prioritize the future self as well. One of the other most astonishing facts to me that I found was that 56% of Americans only save less than $500,000. I'll talk about it a little bit more in a future slide, but if that $500,000 is in the stock market or in your 401k, there is something called the safe withdrawal rate. It's been statistically proven that in order for that money to basically last 30 years, you can only take out 4% of a return on that. So of that 500,000, you would only get to take out $20,000 a year in order to live on. Again, not a whole lot of money. And then finally, and what speaks to me really coming from the corporate world is that 2/3 of retirees are forced into early retirement. Now, this can be for many reasons. They could be in careers where they're aged out because of their, eyesight, like pilots. There's a maximum age. But this also includes individuals that are near retirement and are forced out of their job because of corporate downsizing. These are impacts that are outside of our control as a corporate employee that has a dramatic impact on our lifestyle. So our revolution, my husband and I's resolution, came really right after we had our children, and we were at the point where we realized, oh crap, we need to start saving for college. And then, oh crap, we weren't saving as much as we wanted to be saving for retirement. We had been investing in our 401k as we were supposed to from the start of our career, but we realized that that 10 or 15% contribution annually wasn't going to get us to our ideal retirement age of 55. It was going to be more like 65 or beyond. And we just weren't comfortable with that. That wasn't what we were looking for. So we made the decision that we needed to figure out how to grow the gap between income and expenses. Now, this is my husband and I at our 15-year service celebration, which is happening tonight. So thank for you Disney cast members that are here. I guess not thank you, you're not celebrating, but some of the folks that were going to come are celebrating tonight. And this was ours at 15 years, just a couple years after we had this initial conversation of realizing we really needed to grow the gap between income and expenses. One of the ways we chose to do this was we made a commitment to adjust our spending so that we could live on one income while earning two incomes. We did this by really aligning our spending to our values. One of the line items that was big for us was we were spending over $2,000 a month on food from eating out as well as groceries. And when we looked closer at it, we discovered that we could cut that down to about $1,000 a month. And that gave us $1,000 a month that we could invest. That's $12,000 a year without really suffering too much, right? Like $1,000 was enough to eat on. Keep in mind, this was in 2017 or 18. The other piece was that we made a very conscious effort to curb our lifestyle inflation. So as our incomes grew through annual merit increases, those measly 2 to 4% increases, or job growth opportunities as we were promoted in the company, we did not change our lifestyle. So at the point we had this conversation, I was a sales and marketing strategy manager for our timeshare business. At the time of leaving the company, I was a senior manager in business planning. Through those, it was almost 6 or 7 years, the several promotions that I received and salary adjustments, that all went directly to our savings account that we were then able to invest in order to grow our income streams and our passive income streams so that we could get to this point where we could be work optional. So it was really focused on investing in the gap. Now, when we talk about investing in the gap, there's really two main ways to invest in it, either the stock market or real estate. We were already investing in the stock market through our 401ks and had been doing that for many years. Through our education, even prior to this conversation, we realized the amount of fees that are involved with target date funds and had already made adjustments to our 401k portfolios to get out of the target date funds and into low fee index funds. Again, this is not investing advice, but please check your 401ks and see what you're investing in and be mindful of the fees. Just like compound interest on returns, the same thing happens with fees as far as compound interest on fees. The other great option was real estate. Now, at this point in time, the only real estate we owned was our single family home. I grew up in a family that was not versed in real estate. In fact, I was told stories that landlords were slumlords and all tenants or residents destroy properties. Whereas my husband's family, they did grow up in real estate. They were a family of real estate agents, and they had a few rental properties from here or there. So there were two main factors in our decision of what route to really lean into and invest this gap that I just talked about. And that was understanding the volatility of each of these markets so that we could feel more comfortable in the money being available or the funds, the investments being stable, and then the growth rate. So when we look at the volatility of the stock market, and this is specifically the S&P 500, over the last 20 years, the quarter over quarter percentage change is roughly 6.5% plus minus. This is what I like to call the stock market roller coaster. It goes up, it goes down. We've experienced that in the last year, right? We look at our portfolio. In 2022, the stock market went down 19%, I believe, or was it 20? 19 or 20%, it went down. So the stock market roller coaster is a real thing. And depending on when you're going to retire, that could really have a significant impact on your ability to retire. The other piece was looking at commercial real estate. And I'm calling out here commercial real estate. What I honed in on was apartment complexes. We did look into single family homes. Again, we'll talk a little bit about that, but we did look into single family homes, Airbnbs, flipping properties. Commercial real estate is really where we found the biggest value and stability. So in the commercial real estate sector, over the last 20 years, that volatility is only 1.8%, nearly 2% plus minus. So it's a lot more stable. And then what really trumped it for me is the fact that when we look at the annualized growth rates, or CAGRs, as e-finance folks are familiar with, if we invested $1 million back in 2000, and then we go forward and let all the returns compound over that period of time to last year, we'll see that the S&P 500 had an annualized return of 5.3%. So when you take into account all that volatility, the annualized return is 5.3%, whereas commercial real estate is 7.8%. And you really see that difference. That's almost $2.5 million in value difference between real estate and the stock market. That sealed the deal for my husband and I. The other piece that I mentioned a little bit earlier is when you retire and you want to start living off this income, there's really one way that you pull your money out in the stock market, and that is you sell stocks. You use what's called a safe withdrawal rate, and that is this 4% that you see right here. That is a very well-known, proven percentage that you can withdraw from your portfolio in order to not run out of money over the next 30 years. So think in your lifespan. That provides you with about $128,000 a year in annual income to live on. Conversely, with real estate, it's not called a withdrawal rate because you're not selling the properties to get this return. This is really your cash flow. And what we're doing in these large apartment complexes is that we typically have what's called a preferred return. It's not a minimum return. It's not a guaranteed return. Basically it's the minimum return you will receive as an investor prior to the management group receiving a share of their return. And it's typically accumulated. So you will receive that before the other leaders receive their share, the general partners. We'll talk a little bit more about that. But what's so big is when you see that amplified, not only is the dollar amount, the nest egg, much larger in real estate, but you have a higher cash flow or withdrawal rate. And so you're living on nearly $500,000. And I feel like an infomercial here, but wait, that's not all. That's not it. When you're selling money in the stock market, you're also paying taxes. You're going to pay long-term capital gains tax, which is typically 15%. Real estate, on the other hand, is super tax efficient. You're not going to find a better investment from a tax perspective than real estate because, quite frankly, the government doesn't want to provide housing to the country. So they incentivize property owners by way of tax credits or tax through the tax code. And so we're able to take depreciation benefit. Now, it doesn't mean that I'm never going to pay taxes on this $448,000, but I'm going to defer it. I'm kicking it down the road. So I'm going to pay it with future dollars. And there's strategies where we can continually do that indefinitely, provided we continue to invest in future deals. So now I'm going to talk real estate specifically, a bit about traditional investing versus group investing. So traditional investing is probably what, if you've ever thought about investing in real estate, this is probably the way you've thought about it. You, your spouse, your significant other is going to go buy a single family property. Maybe there's one in your neighborhood you like. You're going to rent it out. Maybe you're going to fix it up and then you're going to rent it out and somebody else is going to pay rent. And that rent is going to come to you because you're the 100% owner of it, which will then go to pay your expenses, hold in reserves, and then you'll cash flow a couple $100 a month if it's a good deal. The other side is group investing. And this is where we have a group of investors who provide capital as well as a group of what we call general partners, who are the operators who really do all the work. And they partner together so that we can buy an asset larger than we would otherwise be able to acquire. And then we share in the returns of the property. The risk rewards of both of these. So in a traditional, it's higher risk because it's solely on you. So it's based on your knowledge, your experience, your education, your financial means. From a group investing perspective, you're sharing all those risks because you're now able to leverage other active investors who's often doing this as full-time experience and network. And you're able to also leverage, because there's so many more units, if you have a vacancy of one unit in a single family, that's 100% vacancy, or you have no income. In a large apartment building, you might be missing out on 1 or 2 units of paying rent, which can easily be absorbed then by the rest of the units. So what is this group investing called? It's called a syndication. And what's so great about a syndication is, as a limited partner or a passive investor, you are 100% passive. And so this is how I got started investing in real estate into syndication specifically, as I was a passive investor, actually in a 45-unit RV park in Lake Okeechobee here in Florida. We're actually just going to market to sell that property. February, it will go on the market. So we're excited to see what that looks like. But syndications are regulated by the US Securities and Exchange Commissions. And they're private securities that are offered by a group of general partners. So that's like myself and my team. We're the active partners in them. And then we offer them to limited partners, also known as passive investors. Now, again, for those of you at Disney, you probably remember from 5-10 years ago that one of Disney's slogans was, Disney's best kept secret. It was Disney Vacation Club. I think one of the best kept secrets in the investing world is syndications. Syndications, up until 2013, they were not available to the normal people. I'll just say normal people, to people like you and I probably. They were only available to the wealthy. If you had $1 million net worth or higher, that was the only way people were able to invest in real estate syndications. So it was really a country club conversation. And with the change in some of the provisions in the Securities and Exchange Commission, they now allow non-accredited investors. And we don't have time to necessarily go into detail what non-accredited versus accredited means, but I do have a resource at the end you guys can get if you're interested to learn more. But in 2020 alone, there were over 120,000 people that participated in this type of investment offering. And then I'll just touch on, there's 2 main types of investment offerings. You don't really need to know the difference right now. 506B, which is only open to people that have pre-existing relationships. So, you and I have individual conversations. We better understand your investing experience, what your investing goals are. We would see if it makes sense for you to pursue this type of investment opportunity. Or 506C, which is only open to accredited investors. An accredited investor is somebody that, that's that wealthy person, if you will. They have $1 million or more net worth, or they meet certain income thresholds. And what we have on the right side here is really just the business structure of limited partners and general partners and coming together, whereas the general partners on the far right provide some of the money up front. We're doing due diligence, we're paying for legal fees, we're signing all the bank debts. And then the passive investors are providing more of the capital, but they're doing no work. And that's the beautiful thing as a passive investor, that myself and our team of general partners, we handle the entire business plan. So you may be wondering, well, how do we make money in this deal, right? So what we do is, when we identify properties to acquire, in the first year or 2, we renovate units. We acquire it, we renovate units, we handle deferred maintenance. We're seeking out properties that have deferred maintenance, properties that haven't been renovated in many years, they're not up to market rent, and we can go in and do these renovations, bring rents up to market rate in order to help force the appreciation. In year 3, we've typically stabilized from a renovation perspective and completed that. Occupancies are above 90%. Typically more like 95. I invest predominantly in the Southeast United States, so Florida, Texas, Georgia. We are very constrained from a supply perspective. So we do maintain higher occupancies by and large. And then we also look at adding amenities for our resident experience. So new playground, dog park, maybe a grill out area or hangout area for the residents as well. And we look at the potential opportunity to refinance. And then in year 4 through 6, we'll continue to operate the property, continue to renovate, raise rents, and then look for the opportune time in order to sell it. And what this looks like from a deal return perspective, and this is all just a sample. Again, I'm not pitching you guys a deal right now, so this is just an example for you guys to kind of look under the curtain, see what it's all about, and then if it intrigues you, we can have additional conversations. But this is based actually on a deal that we did in November of last year. We closed on November of last year. And all of our investment opportunities have different minimum investments, typically between 50 and 100, but we always use 100 as the example because it's just easy math. In the first 1 or 2 years, like we talked about, we're stabilizing the asset. So we typically have lower returns in order to continue to put money into the property. So we have 6% cash on cash returns. And then in year 3, in this example, we've got an 11% cash on cash return, and we are planning to do a refinance on the property. And as part of that refinance, just like a single family property where you might do a cash out refinance, we do cash out refinances on these large properties and put them into the best debt that we can. And in this particular example, we're looking at pulling out about 60% of the investor capital to return to them. And then they will still maintain their ownership share, which is so cool. Year 3 and 4, we're going to continue to maintain it. You see that we're at 8% cash on cash, but the actual dollar amounts are smaller. That's because the actual capital that is still in the deal is a smaller number, although they still own the ownership share that they originally got with their initial investment. And then in year 6 is when we are looking at selling this particular asset. And so that's when we'll return the remainder of the capital as well as the proceeds from the sale. So when we look at the total return of this project over the 6-year horizon and $100,000 investment, investors are going to receive about $33,000 over the life of the hold period in just cash flow. So those are quarterly distributions that will go into their bank account. That's passive income or mailbox money. They'll receive their return of capital really in two different big chunks, one at the refinance and then one at the sell. And then from their proceeds of capital, they receive an additional $75,000, making their total return 109% over a 6-year hold period. And that gives an average IRR of 18%. So pretty impressive returns when we're looking at these deals. And this is what gets me so excited about these type of investments. And quite frankly, this is why I was able to step away from my job at Disney, because I've been investing in deals like this for the last several years. And so as you start to put deals on the conveyor belt one at a time, and you see the refinancing return from there, and you're building up the cash flow, and then you start to see the turn of projects, it really adds up. It's super powerful, and it's a lot of freedom there. One of the other things I like to share is that how we value a commercial asset like an apartment building versus a single family home. So if you sell a single family home, it's going to be based on what your neighbor sold for, or what the last 5 houses similar to yours sold for within a half a mile radius in the last 6 months. That's kind of the arbitrary parameters for a appraisal on a single family house. For apartments or for commercial real estate, it's based on your net operating income. And this is where we're really driving or forcing the appreciation when we identify the properties that have an opportunity to be brought up to market standards. And then we can do really that heavy lifting of it in order to extract that value. So the way the value is calculated in apartments is it's based on your net operating income. And then this cap rate, what the cap rate is basically the assumed return on a property with no financing in a given area. And cap rates in the last couple of years got really compressed down to we were seeing 4% cap rates. And now they're starting to extract a little bit as the market's getting a little softer. But even at a 5% cap rate, which is something we're seeing more regularly in the markets that we're in, a $1 increase in our net operating income adds $20 of value to the property. So for instance, this picture here is a property that we own called the Riley. It's in Tallahassee, Florida. It's a 136 unit apartment complex. We're actually adding a lot more value than this, but as an easy example, if we added $100, if we added enough value that we could competitively get an additional $100 per month per unit in rent increases, which is $163,000 a year, over the 5% cap rate, we would be adding just over $3 million in value to this property. Now, a lot of people will think, I don't want to, I want to own the whole thing. I don't want to own the small part of something. But in this particular example, even if you only owned 3% of this entire project, that's $100,000 of gain in your pocket from that. And I'll tell you, this particular project, by the latest calculations, we're already up to about $7 or $8 million in value. So there is a lot of opportunity to be had in these type of deals when we are really, again, forcing appreciation. We're not betting on these rent increases that we've seen the last couple of years. We're really forcing it through the value add renovation process and operation process. Now, one of the things I shared before we wrap up is that I mentioned during the happy hour that I truly believe that anybody can achieve financial independence within 10 years. And I've put together kind of now this is a very linear approach, right? Like, this is everything goes perfect. This is happy path here. But I think it's a great example of just how powerful these type of vehicles are. In this example, the assumptions are really realistic to what we've seen in the last 12 to 24 months of deals, of the assumptions that we've been doing, where we're looking at doubling investor capital over a 5-year hold period and seeing 8% annual cash on cash return of the cash flow. So in this example, you would invest $50,000 in year one. And again, I'm not pitching you anything. This is an example, because this stuff is so powerful. And I just want to tell the entire world. So in year one, you would invest $50,000. So going back to the very, very beginning, you might be going, how am I going to come up with $50,000? You go back and you think about how you grow the gap between your income and expenses. And it's a combination of growing income and honing your expenses to align with your values. If you get bonuses, that's another great way to, have these lump sums of money that you can invest. But you invest $50,000 in year one. In year two, you invest another $50,000. And in year two, when you invest your additional $50,000, you're also going to invest the cash flow that you received from your year one investment. So that's another $8,000 on that. $4,000. Year 3 through 10, you're just rinse and repeating. Every year you're putting a new $50,000, and any cash flow that you get from it, because you're still working your W-2, you're still bringing another source of income that you're living on. This is your investment pool. You're putting in fresh $50,000 every year, and all of your cash flow, you just reinvest the next time you invest in a deal. And then when you hit year 5, when we start to sell assets and return that when we return that double your equity, you're going to take all that and reinvest it as well. And that is what you will do over the 10-year period of time without fail. Your $50,000 never goes up. It's just $50,000 each year, plus reinvesting everything you get out of it. In year 11, you will be able to live on $82,000 of passive income. Now think of what you could do if you had an additional $82,000 of passive income. You've put in $500,000 of capital through this 10-year period. Your portfolio, like the equity in your portfolio, is well over $1 million. And now you're getting to live on additional $82,000 without touching the principal in these deals. All of a sudden, you don't feel so tied to the corporate world, and you have a lot more option. And maybe you love your job, and that's great. You can keep doing that, but think about what you could do with that $82,000. You could go on that $12,000 trip to, a European vacation, or maybe put your kids through private school or put them through college. So it's so powerful when we start to think about it this way. And while, again, this I think is a really great example of just showing the power of investing over time, compounding those returns, and then seeing the returns and the results at the end of that. So what's next? So if you're feeling the pressure of the stock market roller coaster these days, and you're hoping that this year goes up to make up to the losses next year, then it may be a perfect time to really start looking at alternative investments like these apartments. We're doing, it's not for everybody, right? It's for a certain type of investor. So that's something to definitely keep in mind. But the best way to figure it out is to have a conversation. And so some of you may have some more specific questions, and I'm happy to chat about those as well. So what I would ask is that I've got a QR code on the screen. If you're interested in talking more, feel free to grab some time on my calendar. I'll have some evening and some weekend time so it can work around your work schedule as well. And oh, if you didn't see, you may have already seen when you registered for this event that I have this really cool book. It's called the Financial Freedom Playbook. It's a 12-page playbook of how to achieve financial freedom through apartments. It touches on some of the things that we talked about here, and it also goes into some more depth. So a great resource. I'll put the link to that in the comments. And I guess that's really it. It was great to see you all. Let me put this link in the comments. Got that in the comments. And yeah, I'm seeing some great comments in there. I appreciate everybody joining me this evening. I will say I'd love to end it with one of my favorite Disney quotes, and I'm sure it's one you guys have heard as well, and that is, "It's kind of fun to do the impossible." I feel like this journey that I've been on the last 7 or 8 years has very much been doing the impossible because it goes against everything we hear in society of what we can do. So with that, give me one more cheers, and I look forward to connecting with you all and seeing you out there. Have a great night, everyone.